Go. Good morning, everyone, and welcome to Wiser Technologies earnings call for the first quarter of 2025. We appreciate you taking the time to join us today. My name is Lubomir Yankov, Investor Relations Director at Wiser, and I will be your host for today's session. Joining us are Kosta Jordanov, CEO of the company, and Kliment Nachkov, Wiser CFO. Together, they will walk you through today's agenda, which includes a brief introduction to Wiser, key business, financial, and corporate highlights, guidance for second quarter and for the full year 2025, and upcoming corporate events. Following the presentation, we'll open the floor for a Q&A session. You're welcome to submit your questions in English via the Q&A feature in Google Meet, or raise your hand to ask them directly. Now, let's begin the presentation. Kosta, over to you.
Good morning, everyone, and thank you for joining us today. I will start with a brief introduction of Wiser. We are an IT services company that designs and delivers advanced custom software solutions for the world's leading organizations across Europe, US, and the Middle East. We focus on serving enterprises and industries that particularly appreciate reliability, quality, and security of their software solutions. And we serve industries such as financial services, automotive, aerospace and defense, communications, telecommunications, and as well as other information service companies. We have about 550 software engineers, amongst them many scientists and PhDs, located mainly in Bulgaria and Serbia. We do have a few people around the world, but kind of these are our two major delivery centers. In 2024, we did three significant for our size M&A transactions, and the first half of this year is dedicated to a big extent to the integration of all of the companies into one single company called Wiser. Happy to report a very good progress with respect to the integration effort, which is a complex integration of several companies. I would like to express my very special gratitude to our whole team for the great energy and the great work to make sure this happens. As of today, we have a single common organizational structure, unified processes, which are still under development as processes themselves, but the whole organization is using the same set of processes, and a single brand. So we are now all Wiser, and it doesn't matter anymore for any operational matter who is coming from which original company. Also, at the end of Q1 expired the earnout periods that we had in some of the M&A transactions. So the whole team's interest is now 100% aligned to the success of the whole of Wiser. We are also undergoing the process of a legal integration of the companies into a much more simpler structure. And this legal integration is expected to be completed at the end of the year. Throughout the first quarter of this year, despite this kind of a lot of internally focused effort, we continue to deliver revenue growth with 9.1 million revenues for the first quarter in euros, compared to 8.2 guidance that we provided at the last earnings call. The 9.1 million represented 23% organic year-over-year growth. And of course, and Kliment will go much deeper into the numbers. You'll see also the M&A growth. The organic component is probably more indicative for how the business is developing organically. We are also seeing and continue to gradually improve the gross margins. I'll take a moment here to make a note on how we calculate gross margins, because there is not a 100% unified way within the industry, and we are taking a more conservative approach, meaning we are moving a vast majority of the costs above the gross margin. More specifically, not only the billable time of the engineers, but also we put the non-billable time of the engineers above the gross margin. we put the engineering management time. So people who are managing the engineering team and are not supposed to be billable are still above the gross margin. There are two additional adjustments that we will do in our methodology starting Q2. And this will be moving a couple of additional types of expenses above the gross margins. And those are number one, external sales commissions. Right now they sit in sales general and administrative costs. But we want to take an even more conservative approach to calculating gross margins, and also make it more apple-to-apple comparison when we compare various projects in terms of contribution margin. And also we'll move some additional travel costs above the gross margin. So with that note, and those two adjustments that I mentioned will probably impact the gross margin with something like 2-3%. So with those adjustments, it's more likely 26 versus 28. And this approach, again, is kind of quite more conservative than what most of the other companies in the industry are doing. Compared to the other companies, and we use three sectors, global public IT service companies, local peers, meaning East European IT service companies on East European markets, and IT service companies listed on the Frankfurt Stock Exchange. We are at about the industry level for the first two groups, and also happy to report that the newer projects that we started throughout the last few quarters have a higher average contribution margin, and this is one of the drivers for the continued improvement of gross margins. We still have high sales general and administrative costs, with 25% in Q1 2025. Part of this is due to the continued integration costs, and they will be gradually phased out till the end of the year, as we plan to complete 100% the integration within this year. They also include some significant one-off costs with respect to brand positioning. We actually hired a major international agency to help us position Wiser in a way that reflects our ambitions. And this is an ongoing project, and you'll see the results in beginning of Q4. But also there is ongoing investment, which will continue and maybe even accelerate into sales expansion. Also, 1 year into Wiser, 1 year after we announced Wiser, with the merger of three companies, and with the integration, most of it done, and with the kind of new team learning much better how to work together and how to operate together. It's also a good time for us to do a restructuring focused at having a leaner and simpler structure to speed up execution. And this is something that we're going to do over the next couple of months. In terms of industry, we continue to see a very rapidly changing industry, and by industry I mean IT services. AI is changing productivity in a very big way, and also changing client expectations with some lag, and also starting to change business models. We are also starting to shift more and more of our work from time and material to fixed price projects, which gives us the ability to, as we deliver increased productivity, essentially share this extra productivity with the clients by being able to deliver more for less, but also keeping some of the margins in the company. And we're also seeing kind of the early stages of value-based business models, where IT service companies sometimes start to charge based on the actual results delivered. So if they deliver a project focused on optimizing costs, maybe they get a percentage of the savings. If it's a project focused on driving revenues, maybe it's a percentage of the contribution margin of those revenues, and so on. And we've seen this with every single previous big revolution in IT. So if you look at starting with PC, then internet, then cloud, then mobile, then cloud, every single one created new champions, because these are huge shifts in the industry that create a lot of opportunities for those who are agile and could take full advantage of those changes. We're absolutely seeing the same thing with AI, and we will see new champions in Europe. And as Wiser, we have the ambition to be one of those new champions. And even though we are relatively small, we think we're very well positioned to and have a good shot and becoming one. Within Wiser, we continue the process of AI adoption. And at the last earnings call, our colleague and CTO, Mitko, spoke more about that. Very briefly, these are two groups of initiatives. The first one is focused on applying AI internally to improve our efficiency. And we continue to make good progress, especially in the software engineering department, with more to come, way more to come. And the second aspect is making sure we have the capabilities to deliver cutting-edge AI solutions to clients. And we're seeing more and more of our revenue actually being generated from projects that are AI-based or at least have AI component in them. We feel that with the current positioning of Wiser, it is very relevant to the market. AI, number one, which we see continued demand, and kind of the capabilities that we've built and that we continue to develop are well appreciated. Number two, our positioning in the aerospace and defense is quite interesting with everything that's going on in Europe. We see a lot of interest from the large European IT service providers to partner with a company like Wiser. No surprise, given the huge budgets that will be invested in aerospace and defense in the coming years. Germany alone voted 800 billion investment in defense, and reality is the full supply chain is not there. So specifically on the software part, there will be a need for participation from other European companies. And again, Wiser is very well positioned with our experience, certificates, relationships in this space. In the last couple of weeks, we announced 2 new projects for the European Defense Fund, again, with some of the major players across Europe, as well as a project for the European Space Agency. So we continue to also do this kind of cutting edge work on European level. And the last important component of our positioning is our kind of gradually stronger local presence in the Middle East. This is a region with a lot of ambition to be a leader in information technology, in AI. And we continue to see kind of revenue growth from the Middle East, and we could continue to see great opportunities for more business and for full application of our kind of advanced capabilities in the region. Also, we're in the process of establishing a legal entity in the UAE, which is required for some of the projects that we're planning to work on. And final note on the business highlights slide, on the impact from some of the microeconomic things that we're seeing happening. Number one is probably has the biggest direct impact on our business is the exchange rate, and more specifically the appreciation of the euro versus the US dollar. As of today, like 95% of our costs are in euro, and 26% of our revenue are in US dollar. So essentially, the 10% appreciation of the euro led to direct impact of -3% of the EBITDA. With respect to the whole tariff discussion, it has both kind of the direct impact is for now is less significant, and there's not much talk about tariffs on services, although it would not be shocking if this happens if things continue to escalate, and then it will have significant impact. And number two is via clients. Some of the industries that we serve, and a good example would be automotive, are hit pretty hard by the tariffs and are in cost-saving mode. Quick overview of the corporate events. Year to date, we changed our ticker to WISR. We acquired 100% of our operations in the US. They were in collaboration with a local partner. We did a capital increase specifically for employees and had close to 100 people participating capital increase, which we completed in February, March timeframe. In March, also 3 new board members joined the board of Wiser, people who bring a lot of industry experience and people who are already making a difference in how the company operates, and also in the amount of partners and clients we have access to. Wiser also became part of Sofix in March at the March rebalancing, and we continue to do the legal integration of the companies, including rebranding our operations in Serbia and filing with the trade register for the merger of 3 of the companies into Wiser Technology Solutions, and more is to follow throughout the rest of the year. And with that, Klimo, I'll hand it over to you.
Yep. Thank you, Kosta, and thank you everyone for joining this session. In terms of financials, first quarter 2025, we have 9.13 million in revenues, which is a significant growth of more than almost 330% reported revenue year over year. Of course, this is affected by the M&A transactions in 2024, but still on organic basis, we still grew about 23%, which is in line with our target of more than 20% growth. With regards to profitability and EBITDA, we have a positive 231,000 euro, which is about 2.5% of the revenues. It's not great, but as you can see, it's in line with the seasonality of our business for our company. Wiser, historically, Q1 has not been that great, and this is not uncommon for the industry. Q1 and Q2 are traditionally usually slower, and then the business picks up in Q3 and Q4. And of course, we still have some of the integration costs that we carry and will continue to do so for a couple of months going forward. Looking a little bit in more detail in the P&L, as Kosta mentioned, about 26% of our revenues is in US dollars, and it was affected. The depreciation of the dollar affected us, and then we have the largest chunk of our expenses are, of course, costs related to remuneration of our employees, and then we have external services, which is a significant part of our cost as well, and those are mostly subcontractors. When we need to quickly staff projects with specific know-how and technology that we don't have in-house, we have to reach out and get to our network of subcontractors, but we're planning to optimize this and to hopefully reduce it going forward. Overall, workforce costs increased slower than our revenue, about 280% reported revenue and costs compared to 329. Again, in terms of EBITDA, we are moving in the right direction, still not there where we need to be, but this is also affected by seasonality in Q1, and you'll see probably the same thing in Q2. In terms of breakdown of our revenues, we are changing a little bit the way we report the industry that we operate in. High tech, we're replacing it with information and communication technology, ICT, which includes general IT transformation and consulting services not relevant to a specific industry. This represents about 57% of our revenue for Q1. Financial services is the second largest component with 17%, and it increases, and it will likely continue to increase. Then aerospace, automotive, and defense, they decrease to 12%, mostly due to the challenges that the German automotive industry is facing right now. With the significant budgets allocated to defense, we hope that this category will increase in the following quarters. In terms of geography, Middle East grew significantly and is now 21% of our revenue. It generates about 21% of our revenue. This is likely to increase even further. North America represents about 35%. This is US, and we have clients in Canada as well. European Union, excluding Bulgaria, is with 21%, Bulgaria 13%, and Europe, non-EU, mostly UK and Switzerland, with about 9% of our revenue. Our revenues by currency, of course, the largest share is with Euro, 51%. Hopefully, when we join the Eurozone in Bulgaria, this will change to 67% because the Bulgarian lev represents 16% of our revenues right now. We have 26% in US dollars, and this, as we mentioned, affects our revenue and profitability, the depreciation through the depreciation of the dollar. We are trying to diversify because pretty much most of our contracts from the Middle East are in US dollars. We are trying to diversify this, and we are pushing our contracts with North American clients to be in euro, and we are somehow successful there, more so with Canadian clients, but with some US clients as well. Looking at our balance sheet, it's a pretty stable position. We have cash at 4.4 million euro, but it's important to know that we have about 920,000 euro reported in other receivables and assets. This is because we received the payment in Bitcoin from one of our clients at the end of March, and we converted it in the beginning of April without losing any major value through the change of the Bitcoin value or transaction costs. Our investments decrease, and this is due to the depreciation of the Trevor stock price. Unfortunately, the company is facing some challenges, and this is reflected in their stock price on Nasdaq. Hopefully, this will change, and the company will move back to a better trajectory. Now, with regards to the expectation for the balance of the year, we expect Q1, which is again not the best in terms of business seasonality and company seasonality. We expect revenues of probably a little less than 9 million euro. But overall, for the balance of the year, we are on the right track. We confirmed our expectation for revenues at about 38 million for the entire 2025. And we are targeting still 6% EBITDA margin, about 2.3 million euro. This revenue, 38 million, represents about 14% organic year-over-year growth. And on a reported basis, it's going to be significantly more than 80%. This is the summary of our financial results for the quarter. In terms of upcoming corporate events, important to be noted, we will have the General Assembly on June 19th. We are planning to publish our Q2 results at the end of August 29th, and the next earnings call will be scheduled for September 4th, shortly after we publish the results. This is our presentation. I'll give the floor to Lubo now to open the Q&A session.
Thank you, Kosta, Klimo, for the detailed overview. We will now move on to our Q&A session and waiting for your questions.
Yes, Georgi.
Oh, yeah. Okay. Hi. Hi, guys. Congratulations on the strong set of results and on the ongoing integration of the business. I wish you luck and success in this endeavor going forward. I have a couple of questions, and I would like to start with the revenue for the current quarter and the outlook. Could you share some colors on the growth rates of different geographies and verticals? That is something that was not on the presentation, and I would like to hear more on it. I suppose it's Middle East, but yeah, would like to hear it from you.
Thank you, Georgi. On the revenues, yes, we do expect to see in Q2 and likely for the rest of the year, increase in the share of Middle East, and also increase in the share of ICT, information communication technologies. This is the group of companies who are IT companies and communication providers. And most of the work that we do today in the Middle East is for IT companies. We work there on some of the most critical infrastructure, almost on a country level. Very exciting and very cutting-edge projects. And we expect significant growth to be driven by this sector for the rest of the year. One thing to notice is that we are also planning, as part of the restructuring, an organization that is more focused on serving the individual segments that we work on, meaning the various industries, in a more kind of dedicated and strategic way, including starting to kind of package solutions for those industries, something that could help us easier open doors and easier close deals.
And if I may add here, there are really very good opportunities in the Middle East. There is a push for the region to become a leader in digital transformation, and there's a push for digitalization of the business, which comes from every level in the Middle East. We started and we are doing very well with the projects that we're working on, and we see that this will potentially open doors for additional business. So yeah, we expect the majority of the growth for the balance of the year and maybe going beyond to come from the Middle East. That being said, I think that the US market is starting also to recover. We see a lot of interest from there. Still, we have some work to do to close the projects in the pipeline now and to convert them into operational projects. But still, there's interest, there's recovery, and hopefully the political and macroeconomic situation will not slow this down.
And looking into 2026, we also expect to see pickup in revenues related to aerospace and defense. These projects have very large sales cycles, so literally 1-2 years of sales cycle. But as we mentioned, we feel we are very well positioned. Recently, we established a strategic collaboration with one of the largest IT service companies in Germany, and we're starting to bid together directly also for defense bids in Germany, in addition to the work we do on the European level. So again, these will take some time to materialize into our P&L, but we expect to, in 2026, to see some significant uptick from that sector as well.
Yeah, we obviously hear a lot about it in the news and in the media that Europe will commit significant budgets for defense. We hope that the bureaucracy will not make this slow, and it's in everybody's interest to make it as quick as possible. We see interest, but we still have some work to do, and it's not all on us. There is some lag time until budgets are committed to actual projects, and we mentioned that several times, very well positioned to take advantage of this because of our history in the sector. We are licensed, and so we have the proper certificates to participate in this large pan-European project.
And Georgi, you said you have other questions as well.
Yes, thank you for the answer on the first one. And the second one will be on costs and margins. Could you talk a little bit on the optimization initiatives in SG&A, for example?
Yes. So essentially, during this period of time, transitional period of time between starting with several companies and ending up with one unified organizational structure, naturally, we do have more overheads, especially on the SG&A front. Putting aside for the second the investments that we do in in marketing and sales, because those will continue. But also a lot of effort is being put to put together the structure in place. Now we have a single organizational structure. We have very clear ideas how we could operate faster with a more linear structure. And this is something that we plan to execute over the coming couple of months. If you look at the structure of the business, generally speaking, and the big drivers for profitability, so number one is the contribution margin, and this is how much we are making on every single individual project. We do have their legacy projects, which are at lower contribution margins, and we're in the process of renegotiating, and if need be, maybe even replacing those projects, moving forward with new ones. So that's one area of optimizing contribution margins. Then between project contribution margin and gross margin, essentially sits the percentage utilization we have in the team, in the engineering team, or what percentage of available hours are being built to projects and dedicated to projects. We've made good and consistent efforts to improve this number. Today we are at over 85%, which is a good number for the industry. That's 85% of the available time. So after we exclude vacation time and sick leaves and national holidays, there's still some room for improvement. And this improvement, by the way, came towards the end of Q1, beginning of Q2. So it's not much reflected in Q1 numbers. Though that's the gross margin. And then the rest between gross margin, EBITDA is obviously the SG&A. And again, there are some costs there that we could absolutely optimize, including starting from small things like, as we consolidate the IT infrastructure, turns out that we're paying for the same licenses several times because, for example, our cloud service providers, we have now 2 accounts for every single employee. One account for the original company that they came from, another account for Wiser. And this, by the way, is not an insignificant cost. This is like our licensing costs are about 600,000 a year, euros. And there's a lot of room there for improvement, and a lot of other components which combined we expect to drive a meaningful impact. This is as per the original plan. This is kind of the focus of the second half of the year, to finish the year in a place where we feel much more comfortable with the level of margins we have.
And if I may just to add to that, Georgi, last year we were essentially 9 different legal entities, 9 different companies. Yeah, we started the integration process, and there are processes which are cover the entire Wiser and all that, but still we had to report for 9 different legal entities, to consolidate 9 different legal entities because of the legal framework that each one of them is operating in. And as we start optimizing the legal structure, reduce the number of companies, make some investment, and have some common tool for reporting, like a common ERP and all that, this will help us to optimize overall costs. As Kosta mentioned, doubling licenses here and there until we migrate everything to a common source center. This will take some time. It will require some investment, but at the end of the day, it will help us create a more flexible organization and lean organization.
Yeah, thank you for that. Just to finish on this note, going with the Kosta said a more comfortable margin at the end of the year. Where do you envision this in terms of level? Would it be high single digit or even double digit in the double digit territory?
High single digit for the end of this year, but on a trajectory to go to double digit next year.
Thank you on that.
Yeah, we expect a more robust second half of the year. One, it's the seasonality of the business, and two, some of the project that we started in Q1 and Q2 will roll out in H2, and this will, unless something surprising happens, this will help us get to where Kosta just said in terms of margins and profitability.
Okay, thank you. Now we have a question in the chat from Velizar Porwansky. Thank you for your presentation. As I remember, the forecast about phase 2 was 15% organic growth of revenues with 10 to 15% EBITDA margin. As we are seeing 23% organic growth in Q1, do you think we should recalculate our models with something like that number 20-25 instead of 15%?
We stay with the projection of 15%. Q1 was a little bit kind of not extraordinary, but we had some nice surprises in Q1 in terms of projects. So we still aim for 14-15% for the rest of the year. Of course, we push hard, and if we could deliver more, we will. But as we see the rest of the year evolving, and especially as we are in the process of balancing growth with margin improvements, because some of the things that we mentioned, like replacing some of the legacy projects potentially if we cannot renegotiate the terms, this essentially means we'll be sacrificing revenue for margins, and we continue to maintain this balance. We still feel the right balance would be about 15% revenue growth and getting to a double-digit number. Our guidance for next year is to be in that double-digit place. So we, as of today, putting aside any additional M&A transactions, we don't see a much faster growth than that. Hopefully, it also depends on how we roll out our marketing and sales efforts. There might be some positive surprises. Again, we are very well positioned. But from what we see today, we prefer for planning purposes to stick to the 15% growth.
Thank you, Kosta. We have one question in our YouTube channel from Ivan Matev. He's asking, would you consider initiating the listing process in Frankfurt soon, similar to the Sirma did, given that it takes quite some time and we wouldn't want to miss the bull trend on the DAX?
We are in active communication with both the Bulgarian Stock Exchange and Deutsche Börse for this, and even talking to some investment bankers in Germany to explore the opportunity. We feel that it's still early for us in terms of story, and we still need a few more quarters to continue to demonstrate continued organic growth and improving margins. We feel that these two are important before we take this step to make sure we could generate the right level of interest. The story itself resonates with our AI capabilities defense. This is, as we all know, very relevant. So from that perspective, we're in a good place. From the perspective of, because with so many acquisitions, people want to see kind of continued organic growth after that and want to see the margins. So it's actually great that we'll have a second Bulgarian company with Sirma announcing that they're going to Frankfurt. And it's actually closer in terms of service business to us. So it will be very educational also to see how the German markets accept a Bulgarian IT service company after the very kind of significant success that Shelly did. So it's on our roadmap. We're having some discussions. It's not something that we are ready to pull the trigger, and we need more work to do internally and externally with the market, with clients to properly prepare.
Thank you, Kosta. Since there are no further questions, we will now conclude today's presentation. Thank you all once again for your time, attention, and interest in Wiser, and wishing you all the best.
Thank you, everyone.
Thank you.
Have a great rest of the week.
Bye.
Bye-bye.
Bye.